Evening. Welcome to the ShadowTrader weekly video on Sunday, June 25th. I'm Scott Gillum, also known as Scooter. And
who's up there?
This guy down?
That's my line. That's my. I say that. No, I say good evening. Welcome to the ShadowTrader video weekly for Sunday, June 25th. Do you understand that? That's my line.
Okay.
You.
Okay.
Welcome to Trader Brady Bunch here with ShadowTrader. A little new format here, and introducing my new colleague, Scott Gillum, aka Scooter. He's the guy up there. Option strategist for ShadowTrader.net. He just joined our team a little bit ago. Some of you that listen to Brad's show every day, and I know there's a lot of you that have been hearing a lot of content from Scott over the last couple of months. It's been great having him. This is a dry run for something that we've been working on for a while. Basically, Scott and I are forming two options advisories. They're going to be coming out soon, hopefully in July. And those advisories, they're going to be two separate ones on two kind of different option topics, two different trading styles, one more of a longer-term style and one more of a shorter-term style. So specifically, we'll have one that's just on time spreads, and we're also going to have one that is more geared towards weekly options and momentum trading, which will be very, very similar to the trades that you see me put out on Twitter all the time. So it's going to be like that, and I will be involved. So it's going to be a lot of fun. We're looking forward to this. Part of these advisories is that they will include weekly webinars, and that is the reason why we're doing this video together. I am also taking some time off starting tomorrow and all through next week. I'll be back July 5th. So I also wanted to shoot a video on Thursday night before. Next week, which will be July 2nd, Scott will be doing this video solo. He's going to be standing in for me and doing the video. And then hopefully you'll be seeing us back together again later in July. And like I said, what you're about to see in this video will be very close to the format for the weekly webinars that will be included in the advisory that we are looking to do together, where I will give you my usual broad market commentary. Then we're going to get into all the plays that have been done together, you know, in the advisories, the open plays, and then we're going to also talk about a lot of new ideas. We're going to go through a lot of charts, talk about what we're thinking of trading for the next week. We may or may not put those trades out, but it's what we're thinking of doing. So hope you'll enjoy that. And again, this is kind of a dry run for that. All right. Without further ado, Scott, I'm going to get into a little bit of broad market stuff. So just hold tight. We're going to shut off the webcams now. Just so that it doesn't take up too much screen room. And I'm going to get into a little bit of chart action here with you. So let's move this over. So the first thing I want to talk about is, hold on. Scott, I seem to be stuck here with the, is that thing stuck in the chart there, Scott? No, it's not, right? You guys don't see that, you don't see that, it's clear, right?
Yep, you're rocking and rolling.
Okay, cool. No, I'm just saying that little dashboard thing is kind of stuck. I can't seem to get rid of that dashboard thing. There we go.
You can
I'll slide it over here. All right, got it.
Slide it all the way to the bottom.
First things first, let's get into a little broad market action, and then I'm going to get into a little bit of market profile that I think is backing up the broad market action exactly. But specifically, I want to talk about all of the majors here just for a second. So note that we are above the 20. And we are above the 20 on the, there we go. We are above the 20 on the SPX, correct? And we are well above the support point here, and we're holding. But mainly I want you to be concerned with the 20 MA, because when I go through these, you're going to see very clearly that basically everything is kind of riding the 20 or just underneath or above. So look at Dow now. And I'll do DJI. There we go. So notice that the Dow's distance here above the 20. So basically, really easy TA is to always just remember where the broad market is in relation to the 20-period simple moving average. See here? Overextended from the 20, small correction. Overextended from the 20, rally back to the 20, right? So the major averages won't, you know, this is kind of an anomaly where you have a rally this big and it is away from the 20 for so long. More normal is kind of back and forth on the 20. All right, so that's Dow for you. And then here's where things kind of get interesting in that you've got NASDAQ Composite sitting, again, right on the 20. And what's the 20 doing? Just kind of going sideways to up. NDX sitting right on the 20 going sideways. And Russell, again, right on the 20 and 20 going sideways. So when you have the majority of your moving averages, of the majority of your major averages with moving averages that are just going sideways, that tells you that the market is in balance. There's not a heck of a lot going on here, and we're in balance. All right, real quick, I'm going to show you a couple of nuances in the profile, which will completely corroborate everything I'm saying. Those of you that joined the free webinar that I did with Jim Dalton earlier this week, you know that we touched upon some of these things, but one of the reasons that I think that the market continues to chop and then maybe go higher is that we have a classic example of a poor high here. So this is lack of material excess, for you know, lack of a better phrase, whatever you want to call it. We often call this lack of meaningful excess. That's because there's only two little ticks here on the top. An excess high looks, oh, more like this, where you've got at least 4 ticks to the top. Tells you that the auction ended to the upside. That's excess. That's a little bit of excess on the top. This is a poor high because it has no excess. All right, so this is a poor high. And then poor high just means that traders were crowding the plate, getting themselves too long. You have a relatively prominent pop here. You sell off away from the poor high, but when you sell off away from the poor high, you have to always ask yourself, do you have elongation of range? Do you have expansion of value area and range? And I would say no. You have relatively small value areas. You have relatively wide POCs. They're not super wide like this. They're not like really wide POCs, but it's not this kind of structure. People always say, you know, what's good structure, what's bad structure? This is an example of good structure in that the profile is filled in all over and the range is expanded, right? Poorer structure is when you have anomalies and it gets kind of thin like this. And you have very straight edges like that. That's poorer structure. So you don't really have good structure to the downside that's indicative of any heavier selling. Other thing is that you'll notice it took 2 days, literally, to fill this gap during the course of the week. Here's the gap. And remember, it's all about what doesn't happen. Why didn't this day earlier in the week go all the way down here and fill the gap? Why didn't it do it? Because the sellers weren't strong enough. It had to take until the next day to do it. And then the next day when it did it, notice that the overnight low, and this is Friday morning, this is Thursday night to Friday morning right here. Notice that the overnight low is dead equal with the prior day's RTH low, with Thursday's low. Why am I pointing this out? Because I'm pointing this out that this is a market that is not really going anywhere. Remember, a market that has more confidence would not stop that way. It would just trade down through and keep going. And then Friday, what happened again? Now we have a poor low and a poor high. So traders are thinking very, very short term here. Maybe because it's going into the weekend, I don't know. But they're thinking so short term here that when they get prices up to here, they're like, oh, get me out, get me out. It's probably not going to go higher. And when they get prices down to here, they do the same thing. They say, oh, I got to cover this short. I got to cover this short. I don't have any confidence that's going lower. And what does that give you? Just this profile that goes nowhere. 2 days of equal value. And more importantly, where is this value? These two value areas are equal. But look at this. Of all of these days, look at all these closes. That's 5 days the same, 6, 7, 8. All these closes are the same. And on Thursday, Friday, where do we settle? So we close right there. Yes, Scott.
Peter, I hate to interrupt, but we're taping this on a Thursday night, so back your days up. We're now Wednesday and Thursday on those profile charts, right?
You are so right, and this is the reason why I've brought you on our team. Thank you. You're exactly right. So this is being recorded on a Thursday night. You're right. So this is actually this is Wednesday. This is Thursday session. This is Wednesday. I apologize. I said that this was Friday morning. This is actually Wednesday to Thursday are these 2 days. I apologize. But you get the picture. The point I'm trying to make is nothing has changed here. So if anybody's telling you, oh, it's this bias, it's that bias, the market's definitely going down. It's not. The market's definitely going higher. We don't know that yet for sure either. But certainly it's more bullish than bearish. We have, we have better signals to the upside than we have to the downside currently. And short-term traders still manage to be completely in control. All right. Scott, let's talk about gold.
Okay.
Would you like to take the screen, my friend?
Certainly would.
All right, take the screen. Let's talk about gold.
So, and why did that go? Now, we had it before, and now we don't have it. What the heck is going on?
Oh, I see. I apologize. Hold on. I know why.
I think
Hold on.
you need to push.
You're not the. I got to make you the organizer. Sorry. Hold on.
Just right-click and make me.
There you go. Now you've got full power.
So let me take the screen over. And
you've got the spreadsheet too, so if you want to.
Correct.
You can go on with that.
All right. The gold play that we're doing is not actually on the GCs, which is the future. We're going to do the ETF called GLD, Gulf Lima Delta, which is a proxy for it. And you can see that I've got up under a chart that's approximately back to December of this past year, all the way out. Let me change this so it can be read a little bit easier as a trend line. Let's put that in a dark blue. That would be good. Okay. All right, so I've gone back to the linchpin of a lot of charts that we look at, and that's from the election, November side. So if you go from November forward, use the swing out method where you anchor in your starting point, find the next point that it crosses, and just extend that line out. You can see that gold is running still in an uptrend, but we've got these higher highs were made, and now we're starting to make just a minimal higher high and a failure. But this failure is back down to that longer term trend line. So what Peter and I put together as a trade was one that is up here on the spreadsheet, and I'm going to show you that here in a second. This is what we put together. So for every trade that we've done, we started this back in March, did some trades, had some real good success so far, and right now we're running a gold trade, and let me get right to it. This gold trade that we started with was a December 2017 call vertical. We were buying the 125s, selling the 140s. Why did we do that? Well, let's go back here. Let me bring this chart back down a bit. We've got a nice uptrend line. We've made some higher highs. So if I would take this chart and just add a parallel line to it by just going to the same line, the trend line, and duplicating that, and then dragging it to the last failure that we had and try to capture as many of the highs, you can see that we go up to about 128 here in a very short period of time, the end of June. If we are to extend this out and go out to the weeklies, and we go out here to 7, which is July, let's go out to a monthly chart, go right out to the end, and now we're into November, and you can see that we're going to capture something very, very close to this 140. So that was our upside potential. Plus we had failures multiple times at this 140 level. So bringing that back into the daily side, we said, oops, that's not what I wanted. What can we do in a longer term spread trade that's going to get us an advantage as the first trade that we've done? So we did this 125, 140 call vertical, paid $292 for it. Our thoughts were we're going to sell verticals, bear call verticals, or selling lower strike, buying the higher strike for a credit to eat away at this $292 that we've spent. We did one of those already. We did a 126, 131 call vertical that ended last week. Out of that, we mitigated our risk at one point, and we kept 23 cents of credit, dropping this 292 down by approximately 23 cents, or down to around 270. Then what happened this week is we found a bottom, started to move up, and said, uh-oh, we've got risk that we could take off for half of the extrinsic value, or the value of what we sold that 140 for, pardon me, that 140 call, and now just run with a 125 long call, and then do this wash, rinse, and repeat on the bear call vertical in between this 125 and something in the nature of going forward. So right now we're running just a long 125 call, no inside vertical left to go. We're waiting for this chart to show us that its move to the upside is going to be well worth doing that bear call side. Anything else, Peter, on the gold trade? Well, Peter's either on mute or he is. Yeah, Peter's on mute.
Gotcha. Sorry.
Okay, that's okay.
No, I just wanted to mention that it just made sense to us that because the trade had gone against us so much this week, right? Because we've got this expensive spread out there, that if we're confident that gold is actually going to move up, think about it. Where is it going to move up? It's going to move up right here at the trend line. So that's why, again, we're recording this on Thursday. On Wednesday, did we take it off today or yesterday?
We took it off yesterday.
We took it off yesterday, which was great because we took it off like very, very close to the lows. Right. And we said, you know what, we've already taken off like 55 to 60% of that short 140 in profit. Why don't we just close it? And that way, if we're right on the trade and gold does move back up, now we can have a really killer trade on where we're just sitting on a long naked call and we can sell against it however we want, which will be easier than selling against the vertical where you can really only sell another vertical. So we're pretty good. So let's see how it goes. So the other thing also is note that when you have a time spread on like this, you want to be very careful to do things at the right time. I like the fact that time spreads tend to force you to kind of do things at the right time rather than the wrong time. Certain option spreads will often force you to do the wrong thing at the wrong time. But in this case, we know the stock is down, so think about it. Do we want to sell calls? No, we want to buy calls. So we bought a call. I mean, obviously it's a call that we were already short, but we bought it very, very cheap. And of course, we still want to work as hard as we can to get that debit down much lower. We don't want to lose 270 in the trade, but we certainly don't want to sell any calls right now. So we're going to wait. So hopefully the bounce continues. Stock continues back up to the, say, 121, 122 area, and then we'll look to be selling some calls against the long December 125 again. All right, Scott, let's move on to the Tesla trade.
Okay. So let's pull up Tesla for a second and just give you a quick down and dirty on the chart itself. And I've got some alerts here. Let's do the same thing for the trend line, but I'm going to not back all the way up to November, but we could. Let's take the November low, which we've got here. Let me make this a little bit darker so you can see that again. And let's make that a 2. So we went again back to that November starting point, did our swing out method, and we see that Tesla has a trend line that's really low. Well, this is the dominant trend line. Kind of got another trend line going at this point in time that sits right about here. Right? That's at 340. And that's a secondary trend line, and we can even go to another trend line which is going to put us, oops, come here. You are too fast. It puts us right at where we are today. This trend line from the 525 swing low, there's your swing high, but we captured the low from yesterday, and we saw Tesla start to move up and up hard. So predicated to this move back to the upside, were these 4 candles of consolidation. We needed to take advantage, we wanted to put a trade on, we needed to take advantage of this consolidation, but the resolution we believed was to the upside. So putting together a trade, again going back to the spreadsheet, what could we do? Well, we took a look at using the butterfly on both the put side and the call side. So we did both of these. We did a 377, 387, 50, call vertical to the upside, paid 301 for that, and we did a 350, 330 put vertical.
No, Scott, that's the wrong trade, I think.
That's the wrong trade. I apologize. That's the old trade. Here we go.
That's the old trade. Yeah.
There we go. The 352, 350, 337 butterfly. That's on the put side. Though that's going to get us something. Let me go to the Analyzer tab for Tesla and just show you what this risk profile looks like. Let me just put on that put butterfly alone. So you can see that we make money above 347 all the way out to 353. Go back to the chart for just a second. 347 is right down here at the trend line, or below this trend line, right here at the moving average.
Right, 50 MA.
Right, 50 MA. And we're now encroaching on the higher side of this, the 384. Well, that's not going to work for us. We need to do something that's going to take us into the ability to make money more than this little sliver, because you can see the sliver is going to make money all the way out here up to $500 for Tesla. That's not enough money to play games in this marketplace.
Right, Scott, if I can interject just so everybody's clear, and I'll give you the floor right back, is just that the put butterfly is a credit generating spread. It is not about making money to the downside. It's purposely it's really a ratio spread, but it's got an extra garbage put on the bottom just to cap off the risk. That's something that we're hoping to bring to these advisories, and that a lot of people have always emailed me and said, Peter, you always do these 1x2s. I can't do them. I don't have the account size. So for all of these trades in the spreadsheet and the trades that we're going to continue to do, we will not be doing ratio spreads. We will always do broken wing butterfly, giving people the option to do the ratio spread if they have a bigger account, but we're always going to try to cap off the risk. So that's why this is essentially buying a 350 250 long put, selling 2 350s because we see strong support at 350, and then just buying a put way further out and bringing in a small credit to help us finance some of the cost of the call butterfly.
Okay, great. I hope that helps people who are a little bit skittish about putting that risk to that ratio spread type of trade. So again, we're going to make money on this put butterfly, anything above 347 all the way out. Very small amount. We'll only make in the neighborhood of 40 bucks or so if it goes up as far as $500. I want to make more money. So what we've done is we've added a call butterfly, which is the bottom part here, 380, 400, 440, to the bottom part of this trade. What's that do? Well, adding these together, we've got a little bit of area that we're going to lose some money in if Tesla doesn't move. Well, Tesla moves $5, $10, $15 in a clip. So we're going to lose money anywhere from this 350 level all the way up to 386. You're going to say to yourself, oh, those are all-time highs. We can't see this thing going any higher. Well, you really can. If you take a look at the chart again, let's go back to the chart once again. Oops. Think of this as moving. If once it goes to a brand new high like it did today, what's the next logical target for this stock in a bullish move? That's the 400. If it fails and goes below this trend line, comes back down, it's going to come back down to something that was normally there before. That's either the top of this channel or the 50, which are exactly the same at this point. So we're going to make money if it drops back down. Now, made a big move today. Peter and I put our heads together and we said, uh-oh, we've got risk out there with these 2 400 calls that are short. Let's take some risk off the table. It doesn't cost us a lot of money. It doesn't destroy the trade. So today we bought back one of those 400 short calls, leaving us with a 380, 400 call vertical that currently, I don't think I've got this shown to you properly on the Analyze tab. Let's see if I can make this work. Sure, I can do that. I can put this, yes, I've got it now correctly to the 380, 400 call vertical with a 440 long call that's hanging out here. I don't care if this makes money or not. It doesn't cost us much. But you can see now with Tesla being at its current, let's make this its current price, we now have the ability to make money in a $4 move tomorrow, $5 move, $6 move, $8 move, $10 move. If it moves up to that 400 number by the end of next week, this trade is going to be profitable on the call side alone by over $700.
Hugely.
That's the type of trades we're looking at. Ones that are managed, not you get the trade and you let it go to the end, and at the end you get out of it. These are going to be managed trades, as you can see from the spreadsheets. And just going over the spreadsheet, we're going to number the trades, the date it was done, any actions, what we did, the sizing, who that underlying is, the series we've used, the type of spread, and our cost, and some commentary to help you along understanding what we're looking for in the future. As it says here, adjust the fly to a call vertical plus an upside call opens upside potential. And that's the Tesla trade, one of quite a few that we've done so far.
Sounds good. Yeah, this has been, yeah, we've kind of been doing a dry run together, just ourselves. And what I've been doing is I've been sending most of these trades out on Twitter as we've been doing them. A little more so recently than in the beginning, but obviously, you know, these are the trades that Scott and I have been doing together so that we could start a track record before we actually started the advisories to give us some runway before. So anyway, we're pretty excited about it. I think it's going to be really cool. All right, Scott, let's get into some new ideas. We've got 3. And before we give out the new ideas, I just want to give a little caveat in that we may or may not be doing these ideas, but we stand by them. We think they're good ideas. And certainly we're going to give you some specifics on how you may want to play these 3 stocks. I am going on vacation, as I just mentioned, this coming week. As of tomorrow, so I will not be doing any of these ideas. Scott may be. Scott does not have control of my Twitter account, so they will not be tweeted. So just so you know, you guys are kind of on your own on these. However, in the future, when we do these webinars for those of you that are participating in the advisories, more than likely, you know, they will be trades that you'll actually see happen, and there will also be text functionality to your phone, so you'll get real-time alerts straight to your phone. Which is kind of cool, and everything will be updated all the time, and we'll be doing these weekly webinars where we get to, you know, flesh out the ideas together. So, all right, Scott, let's talk about applied materials first.
Applied materials, Alpha Mike, Alpha Tango.
This is one of your favorites. I know you like this stock a lot.
Well, I had this one kind of, I brought it to your attention about a week ago, about 4 days ago, when I was making this flag, and it was coming down hard. It looked like it wasn't going to recover because we made a big downdraft, tried to recover, couldn't get 50% of this, and we then made another downdraft. And it looks like it's failing once again. So how can we take advantage of this downtrending line? You can see here, again, I'm going to adjust this for everybody. This downtrending line and the longer-term trend line, which they're coming to right to a juncture around this 42 level. You've got the 20-period moving average, pardon me, the 50-period moving average sitting down here at 42. The 20, it's already below that. So we need to take advantage of this possibility, and again, it's a possibility that if the stock price drops below the 20, it will look to get down to this longer-term trend line. So we put together a possible trade predicated on the break of that 20-period moving average. So let's go to applied materials. And first of all, let me get this so you can see it. I apologize. There we go. We wanted to do something that was not too long a time, yet would give us enough premium and movement. So I'm going to, first of all, I'm going to take a look at the options chain. We looked at doing something July 7th. Well, we got a holiday in there. We lose a little bit of theta and don't have the opportunity to do anything. We took a look at the July 14 options, specifically on a 43 long put with a 46 short put as our cap to this. Okay, so we're buying the 43, we're selling the 46. Maximum we can make is $3. The 14th of July and the 21st of July were essentially the same debit, $1.15 and $1.12. I like to buy as much time because things can take longer than we anticipate. So we went to the 21st of July. Also a monthly options expiration, also a much larger open interest area for this trade. So if this hits our start point, which means that within the next day, tomorrow, or even Monday morning, I don't think I'm going to let it go past Monday. If it goes below this moving average, and this is the 50-period moving average, and we see a good hard move below or closing right at it, this trade is going to go on the docket of the trade sheet. It'll get us a 43.46 put vertical, maximum $3 of profit on $112 or $300 on $112 of debit per contract. I'm going to do this on a 4 lot. That means we're going to risk approximately $500. I want to back up just a second here. Not everybody's got a $500,000, $1 million portfolio. We need to be able to do risk management properly. So we're going to try and gear these trades to your risk profile that limits the amount that we're putting into the trade for your portfolio size. So I'll start out with 2 or 4 contracts, but these can all be scaled up depending upon how you run your risk management. Let's look at the risk profile on this trade and see how this is going to make us a profit. Okay, currently we're at 41.78 with the trade, and I've got that right. Let's open this up. Pardon me, 47.67 is the current price, and why this moved over, I don't know. 47. Is that right? 47.67. Sure it is. So let's put this at 47.67 here.
But AMAT's at 43.34 currently.
That's what I thought. I don't know why this. Oh, that's a 10%. I apologize. I didn't want to do that.
Yeah, because you got your slices.
There we go. There. My 43.34 is the current price. And you can see we're underwater a little bit. We're underwater by about, $3.66 if we went into it today. Well, we need this to come down, which means that this pink line, which is today's valuation, is going to come back down towards this blue line. My break even is when the stock gets to 44.14. Why have I got this on the call side, Peter?
Because that's what you're looking at.
Yeah, that's what we're looking at. Okay.
Yeah, call side.
So if it takes off and it launches over that trend line, we start to break even about 75, 80 cents above where we are today. Why did we pick the 43? It's got what's called intrinsic value or real hard value. It's got 34 cents of true value. And
like
the
the
rest
hardware
of,
store.
pardon me?
Like the hardware store.
Like the hardware store. You can beat it with a hammer.
True value.
Anything above that, we start to get what's called extrinsic value, and it builds in value. So it's a delta trade to the upside. Yes, we're going to lose money as time marches and the stock doesn't go anywhere because we're right now a little bit above where the fair value is. But with the expectation that AMAT's going to break that line and move to the upside, this trade could be anywhere from, my expectation is doing about 80% of the $3 profit, so about $2.40. I would be pulling this off the table. I don't want to be greedy. So that's our AMAT that's kind of poised, set up, and ready to go.
Sounds good. Also, Scott, I wanted to ask you, is on the AMAT, and I'm not sure how you're going to trade it if you do, but I wanted to put out there that people can wait, if they like, for that downtrend line to break, for that descending triangle to sort of fail and go back to the upside before putting on the trade if they like. It's sort of, maybe a safer entry, I don't know.
Okay, so the entry would be, if you're really aggressive, the minute it closes at that 50, go ahead and buy it. I think you should err on the side of caution if you're starting out here. Let it go below, come back and test it. If it tests it and it says, okay, the water's good above this line, I'm going back up, then use the 50, above the 50 to do your buy side. If you're a day late, okay. If you're a day late and it's going up, you're going to still get the brunt of the movement to the upside.
Correct.
All right. The next one is a big boy.
It's Google. I'll handle this one.
Okay, so I'm going to...
I'll change presenter. Okay.
Slip the screen back over to the big guy.
I've just done it.
We've got an interesting trade for you on this one.
Do you see my screen now?
Your screen is up and running.
Fantastic. All right. So you guys should be seeing Google here. There we go. And this is kind of interesting how the stock has been setting up and just kind of sitting under this 20 MA with what I like to refer to as a shelf, right? This is what we call a shelf right in here. And it's kind of bubbling under the shelf. And so the thought process is that the stock's going to break, and when it breaks, it should break above the shelf, and we should get some movement up in here. And I thought that an interesting play here, and again, this is kind of good examples of the type of like a little bit more esoteric stuff that we want to be doing with you guys later on together. But one of the things I thought of is, how about if we did an unbalanced butterfly short right here where we are, right around that 980 strike. So let me show you what I mean by that. If I erase these drawings and I go into here, hold on one second. I'm not very well versed with the GoToWebinar drawings, Scott. Hold on one second.
It's very kludgy.
It is kind of weird, isn't it? How do you get away from the pen? Do you know?
You should be able to click it off.
Oh, there we go. Normal non-drawing mode. Sorry. Got it. Now I get it. Let's go over the Analyze tab. Let's take a look at this Goog. So basically, what is an unbalanced butterfly? Normally, an unbalanced butterfly is something you would buy, and it would look a bit like this, right? You would basically, it's called a 1-3-2. And what you're doing is you're buying 1, selling 3, and then buying 2 again, as opposed to a normal butterfly, which is buying 1, selling 2, buying 1. And from the long side, the best application of a long, unbalanced butterfly is when you have a short amount of time and you feel that a stock is within a short amount of time going to go to a certain area. So a good example of a long, unbalanced butterfly would be a trade that you would put on in a Jumbotron stock, a FANG stock perhaps, on late Wednesday or Thursday, with the anticipation that on Friday at 4 p.m. the stock will pin right at a certain strike price, and that strike price, of course, will be the midpoint of the trade. And when you buy the unbalanced butterfly, you buy it for a credit, and you actually have a chance of taking it off for a credit if time elapses and you close right in. But for this trade, what I want to point out is this trade can actually be flipped on its head and done the opposite way for a more directional play, where you would then put it on at a debit. And notice that here I'm actually selling the 975 call. I'm buying 3 of the 980 calls, and I'm selling 2 times the 985 calls, right? And if you think about it, it's actually a directional play, because if Google is anywhere above 985, which would represent only a very small breakout in the stock, that would mean that, you know, we closed at 977 here on Thursday. Remember, we're recording this on Thursday. We're closing at 977, right? We're only looking at about an 8-point rally in order for this to be profitable. And how does this become profitable? Well, basically, above 985, this whole thing is going to be worth $5. And the reason it's going to be worth $5 simply is because if you think of it this way, in that the short vertical here, 975 to 980, is minus, I'll put it on yellow, is minus $5, right? Then you've got 2 long $5 verticals, because you got the remaining 20 contracts here. 10 of these 30 cover this 10, and you've got 20 left. So let's call them 1s and 2s to be simple. The other 2 are plus 10, which equals plus 5. And your cost is $1.70. So you've got a pretty good chance of turning $1.70 into $5, which is better than 2 to 1. And what I like about this a lot is the fact that, remember, if Google doesn't go anywhere, let's say Google falls down hard, then obviously the trade's going to be at a loss. You're not going to be able to get back your whole 170. You're going to lose a little bit of money. But if Google goes nowhere and just chops around, don't think of it in terms of being short the 3 or being short this 1 before. Think of it that you're long 3 units at the 380. And being long the 3 units at the 380 is a great thing, because you will always be able to buy this spread back at a decent credit and have a very small loss if it doesn't go anywhere. And again, I like it because the trade doesn't have to run very far in order for the breakout to, in order to make money on the trade. Like I said, only over 985, which is literally like right here on the chart. This is nothing. It only has to be here by the end of the week in order to turn the 170 into 5. So that's an idea as well on Google. All right. Last but not least, we're going to have an idea on Chipotle. I'll drive the chart, Scott, and we'll take this one together. We'll wrap it up together. This is one that we looked at earlier today. Let me just erase all of these drawings. And what we were looking at was the fact that the stock is falling pretty hard. I believe you have somewhat of a head and shoulders top here, pretty bearish. And you've got trend line support happening down here. And the trend line support is also right at what we feel is a important psychological number at 400, correct? And also here at a prior low. So it all kind of ties together. You have a prior low, you have a trend line support, and you have a psychological number of 400. So what we're thinking of doing is figuring out in the next week, can we capture some of this downward movement and make a bet that the stock will move lower, but it will not breach 400 by the end of the next week. So in order to do that, we have to basically put on a bet that is relatively cheap and also has a little bit of risk below the 400. So what we're looking at here is similar to the, let me get rid of these drawings, similar in scope to Google, in that we would use an unbalanced butterfly, but we would be doing it on the long side, and in this case capturing the spread between 415 and 400, and then these two contracts here. It's 20 on this, but two is at the 385 to cap it off. So this actually has risk below 400 because remember you're short 3 times. But what we're looking to do is have that drain out, have the stock go to 400 or close to it, and not break through. And as you can see here, because you're selling those 3 units, you have a very small debit to overcome. This will cost $1.43. And then Scott was saying, well, we can add on something on the call side if we wanted to make it a little bit cheaper. And I'll let him talk about that because we were looking at resistance here. And again, I'll drive the chart. We had some trend lines here. Scott, you can talk about the call side there.
All right, on the call side, that's some money out that we're expecting to go down, but you can also make money using the call side, a bear call again, selling something lower in strike, buying something higher in strike, and capture that premium credit. So looking at this chart, you've got an area that it's had a hard time getting back over. 445, 450, that gap area that we just had also lines up with a high back in July, a high really close to it in October, the big move up here in March, and then the consolidation to retrace, and then the launch. So this 445, 450 area is one that in a very short time frame should be a safe area to sell something lower in strike and buy something higher. So doing that, we took a look at then a bear call, or using the call side.
That's right, right in here.
Right.
445, 455, which is down here. And what you want to do with these kind of plays is you want to try to make it as cost neutral as possible. And you can clearly see here that it'll only take like just under 4 of these to make back $1.43. So we're going to try to structure all these trades, as Scott was saying, in like 2s, 4s, 6s, and 8s. So this would be a good this would be a perfect example of where, for instance, we may be short 8 of these spreads, right, and be long 2 of these spreads here. So it would be like a 2/8, which is a 1/4 ratio, and that would make it delta neutral. And of course, that would also give us a very large area where we would be profitable, right? You can see it's a very, very large area where we would be profitable. And it really only starts to go down hard once we breach that 400 area, correct? A little bit past the 400, but you can see this area is very, very large. So that's what we'd be thinking, is putting it on for no cost.
Peter, let me back up to why we want to do this in 2s or 4s or 6s or 8s.
Mm-hmm.
It's always nice to be able to reduce your risk on part of your position. So if you've got 2, you can get rid of 1. If it's going against you, you can get rid of 1, and it takes some of the risk off of the table and easier to manage. If it's going positive for you, you may be able to take 1 of the 2, or 2 of the 3, or 2 of the 4, and have a free trade running that is, in essence, house money. So that's why we're trying to do these in multiple iterations.
Yeah.
So here we're doing a 4/8, or pardon me, a 2/8.
2/8, right. Scott's exactly right on this. This is something that we thought of. The last few months that we've been doing these trades together, we've noticed that because we want to do smaller sizes officially, and then just let people scale according to their own account size, but officially we want to do 1 lots, 2 lots, whatever, as we said, anywhere between 2 and 8. We noticed that one of the worst situations you can be in is when you have, for instance, a spread that is very long delta or very short delta if it's a downside play, and it's going deeply in your favor, and you don't know if you should sell it because you only have 1 on. That's the worst thing, to have 1 on. The best situation is to have a minimum of 2 spreads on. Stock goes heavily in your favor, you sell 1, and now you've got money in the bank, you got money in your pocket, the trade's paid for, and psychologically it makes things so much easier, and also gives you so much more breathing room to reassess what you should do with your other contracts. Should you then hold through the inevitable pullback and wait? Should you just sell the other one here because it's such a great profit? Whatever you like, it makes a whole lot of sense. It's much easier. So yeah, that is definitely our MO on that.
That's called scaling out, which is
Right.
a very, very good trading mentality to be into. The other side of that is also called scaling in, where you start with a trade and then add something to it, whether it be the same trade again or something that will either mitigate risk or enhance the return.
That is correct. All right. Scott, I think that's going to do it for this week's video. Again, introducing Scott Gillum, aka Scooter. He goes by that name sometime. I want to welcome him officially to our team. And like I said, it's been great doing some trades with him and having some commentary from him. Some of you have heard him on Brad's show in the afternoons, here and there. And so we thank him for his participation on that. And again, just as a reminder, next week I will be away from the desk. Scott will handle this video himself, and then we'll probably go back to like a tag team thing after that. But the next video, which will be July 3, will be just Scott. All right?
Great.
That's it.
Thank you,
Scott,
everyone.
On behalf of both of us, we wish you all good trading and good night.